External risks are things that you cannot control. So this could be the market. This could be the type of asset class. This could be politics. This could be taxes, things that are outside of your control for the most part. The big moment when you have control over external risk is whether you acquire a property or not, right? That's when you're making your decision about external risk. And then, Vinky, my favorite one is systems, because I'm a nerd and I love systems. And so systems risk is around how do you run your business? You know, your business is broken down into really three parts: marketing, sales, and delivery. Every business has some version of those three things. And so we have to understand what those are in our business, how we've structured them, how we've made them work, and how we make sure that that limits the risk of making a mistake or losing an investor or not delivering on the promises that we have.
This is a real estate web show. I'm your host, Vinky Loomba, a commercial real estate investor. And today I have a very special guest, my very good friend, Jeremy Goodrich. Welcome, Jeremy, to the Real Estate Vibe Show.
Vinky, I'm so excited to be here. You are an absolute legend in the real estate world, and it's just a pleasure to be able to speak with you today.
Thank you so much. A little bit about Jeremy. Jeremy is a commercial real estate risk advisor who has been teaching investors how to purchase and protect properties since 2013. He is the owner of Shine Insurance and hosts the Managing Commercial Real Estate Risk podcast. Today, we'll discuss risk management and insurance with Jeremy. All right, Jeremy?
Yeah, sounds like an exciting conversation for sure. Hopefully, we'll open all your listeners' minds around risk management and insurance and teach some tips how to find the best options when you're doing so.
Exactly. I love your name. Goodrich. You know, everybody is always striving to be good and rich. You got both.
It's hard to put those two things together, right? Like lots of people are rich and maybe not that good, and lots of people are good and maybe not that rich. But when you put the two together, I think there's something that sings there. That's certainly what I'm attempting to do in my life. And it just happens to be my last name as well.
That's great. So would you please share your background with me briefly? How did you become who you are today?
Absolutely. So I was an elementary school teacher for 13 years. I was a third and fourth grade teacher, taught math and reading and writing and taught kids how to play hockey and everything in between. I really loved that period of my life. And during that time, I met my wife and now business partner, Mackenzie, and she was a third generation insurance advisor. And so she was managing her dad's insurance agency at the time. And at some point, he sold that agency to a national financial firm, as many, many independent agencies are being sold to large financial firms right now. And so she was kind of at a crossroads with what she wanted to do. I was ready to move on to something different than teaching as well. And we said, well, what if we bring the educational aspect of what I do into the insurance side of what you do and try and change the way people feel about insurance? And so in 2013, I had no insurance experience. I just jumped in doing home and auto insurance, and Mackenzie was doing the commercial, like business insurance. And I just latched on to first-time home buyers. And I just wanted to teach those folks how to buy a house. My whole approach was like, add value, add value, add value. We hear that all over the place now. I'm not sure that was quite as common in 2013, but I just wanted to add value. And I started teaching first-time home buyers how to buy a home. And of course, I wasn't the expert. And so I went out and asked realtors, and I asked lenders, and I asked title company owners, and everyone in between. And I did that. I recorded those videos and posted them on YouTube, and really just started growing in my YouTube following, which now has about 16,000 subscribers. And that really boosted from the beginning my love for the relationship between real estate and insurance. And from first-time home buyers, I moved on to investors in residential, so 1 to 4 family properties, house hacking and duplexes and all that kind of stuff. And then a few years ago, I really leapt into the commercial real estate insurance world. And now that is all I do. I focus on apartments, office buildings, retail, industrial, self-storage. Those are the main asset classes, but really commercial real estate as a whole. That is what I focus on. I provide insurance for that, as well as invest passively in deals is sort of a part of what I'm up to as well. Did that give you the history you needed?
Yes, I think it's great. And you got the best of both worlds, like
Yeah.
the insurance, and you got your education niche kind of satisfied as well, because you've been in the academia for a while. So let's talk about, how does this real estate insurance work, especially in the commercial real estate?
So I think you have to start by understanding how to manage risk. Of course, I have a whole podcast on the topic, but I think as we look at our journey as real estate investors, every step of the way, what we're doing is managing risk. When we're looking out there at a property, when we're starting to plug numbers into a pro forma, when we're making, we're sending a letter of intent or PSA or getting into due diligence, as we walk through particularly that acquisition process, what we're doing is exposing what the risks are. So we're identifying those risks. And then we're coming to understand the risks better. All right, what are the risks associated with this property as balanced with the opportunity that comes with the property, right? One risk could be way too high of a price. That's a pretty big risk, right? And so you say, well, no matter what any of the other risks are, that particular one means I'm going to pass on this deal. Another risk could just be more subtle things. Maybe the sewer system is not set up right, or there's some kind of issue that you don't see unless you scope it as a part of due diligence. Every step of the way, we're managing risk. And so if we look at it from that perspective, then we can see what the tools are that we have to manage risk. When we go through due diligence, any good investor has their checklist, their process, who they bring out. They've learned over time, or they've learned from their coach or guru, or however they learned that they need to go through all these steps in a due diligence process, right? That's their process, their risk mitigation process. Insurance is a tool in that process. It's just one particular tool. It's an incredibly powerful tool, though. Without insurance, most of your listeners would not be investing in real estate. You wouldn't be able to, because very few of us have enough financial backing to be able to have a $10 million property burn down and pay for it ourselves. To be able to get sued by someone who slipped and fell in front of a property and pay for that defense and potential payouts associated with that by ourselves. And so insurance is a tool that we use to manage risk inside of our commercial real estate investing journey. And without it, we just wouldn't be able to do it. The only people that would be able to invest in real estate would be the incredibly wealthy who are capable of absorbing, something going really, really bad. So in some ways, I see insurance as something that levels the playing field and gives us all the access to something that we maybe wouldn't have had access to before.
That's good. And you said it very well, risk, right? That's the very big factor. And we have risk at every step in our life, generally speaking. So when you're working with these properties, especially in the commercial real estate, so what are some of the pointers that you can give us? Let's talk about that a little bit more. What kind of risk, and then how can you look at what kind of appetite you have to take that risk?
Yeah. So in our show, we break down risk as a whole, and we're not talking about insurance on my show. It's just really about risk and how we manage it, the balance between opportunity and risk, right? We break it into 4 quadrants. And so those quadrants are property risk, relationship risk, external risk, and systems risk. So let me just quickly get at that. Property is the risk associated with the buildings, right? The property itself. Things of that nature are really one category of risk. That's kind of what we think of when we think of risk most of the time. The second one is relationships. Now, this is, if you think about it in the commercial real estate world, relationships are, rightly so, based almost 100% on contracts, right? when we put together a GP team, we should have a business contract that says who does what and who gets what. And if someone wants to leave, what it looks like when they leave. When we pick up tenants for our property, obviously there's a contract that goes into that process. When we hire subs, when we bring on capital, all the different things, all the different relationships we're making are based on contracts. And the way that we do that, and that's a risk management system, right? If we didn't have any contracts, then things would go south, obviously, pretty quickly. So relationships is the second one. External risks are things that you cannot control. So this could be the market. This could be the type of asset class. This could be politics. This could be taxes, things that are outside of your control for the most part. The big moment when you have control over external risk is whether you acquire a property or not, right? That's when you're making your decision about external risk. And then, Vinky, my favorite one is systems, because I'm a nerd and I love systems. And so systems risk is around how do you run your business? You know, your business is broken down into really three parts: marketing, sales, and delivery. Every business has some version of those three things. And so we have to understand what those are in our business, how we've structured them, how we've made them work, and how we make sure that that limits the risk of making a mistake or losing an investor or not delivering on the promises that we have. So that's really how I look at risk. And then I break it down when we come to insurance, which I know you want to talk about, and we can dig in here. Insurance really focuses as a tool that addresses some of that property risk and some of that relationship risk.
I understand the property risk could be mitigated by the insurance, but how does it affect the relationship right there?
Sure. So think about if you have a tenant, right? And, you know, you have a tenant who has a dog, and maybe it's a big dog. Maybe it's a dog that has a history of biting people. And then that dog gets loose, bites someone. That person is injured and decides to not only sue the tenant in your property, but also the property ownership entity, probably everyone else they could sue if they hire one of those personal injury attorneys. Your insurance company is going to get involved in that. That's a liability situation, right? That's one type of insurance that's really important to have, is general liability coverage. Bad things that happen to other people because of you, your business, or your property, right? And so insurance is getting involved in relationship risk in that example, because they are protecting you in that lawsuit between whomever was bit by that dog and potentially the tenant, if the tenant says that, you know, there's lots of ways it can go. But that would be an example of a scenario where insurance is getting involved in relationship risk.
And how about the other two? Let's talk about the system first, right?
Yeah. So insurance doesn't really get involved in systems risk. I could probably stretch it to, like, okay, here's an example. So many businesses have a board. Maybe some of your listeners have a board associated with their business. And that board is making decisions. What happens if that board made a decision and that decision went south, and ultimately other people were affected and decided to file a lawsuit against the board for making that poor decision? Well, if you have directors and officers liability coverage, then your insurance policy would get involved in that situation. And if you don't have directors and officers liability coverage, then no one's there to help you. No one can help you walk through that. And in fact, any board that I join, I make sure that they have directors and officers coverage, because it's very common, if they don't, for the personal assets of board members to potentially be at risk in that situation, right? And so if our systems are not set up to protect us in that way, that might be a little bit of a stretch. Maybe we'd say that's relationships, but you know, that was the example that I could come up with for how insurance addresses the system section of risk management.
That's great. So let me ask you one question here. So when you get the insurance, like at different levels in the insurance, that could be covering like different grounds for you. Let's say I buy my commercial building, right? And I say, okay, Jeremy, can you look into that and tell me what the insurance is going to look like? And I wanted to make sure my tenants are protected, they're insured, the basic things are secured on my property. And then, you know, the flood, fighting, whatever, all that is covered. But beside that, you said there's a systems risk, there's a relationship risk. So that's what I was thinking, is there another levels in the insurance that you have to purchase separately, or is it like kind of blanket thing that covers everything?
Well, I think when I put together an insurance policy for an investor, first we obviously talk about the property, about what it is they're doing, how they're structuring it. Is this property going to be purchased in the same LLC as multiple other properties, or are we creating a new LLC, which is commonly the case? Some of those structures there. So we first have to get to know the investor themselves. And then I put together what's called a portfolio overview, and it answers this question for you, Vinky. It really says, okay, here's all the different types of insurance that could be used, all these different tools that could potentially apply to your business. I'll give you an example. Like if you have employees, so if you decide instead of hiring out third-party property management, you want to have maintenance and property manage or maintenance and leasing employees of your entity. That's a common direction to go. Well, we need to talk about some workers' compensation coverage, right? What if someone is injured while working for you? So that adds a risk. So when I bring this portfolio overview out, it has like kind of most of the different types of insurance. Some of them I've included. Property insurance would be common. Obviously, if you own a $1 million building or a $5 million building or whatever, we're going to want to make sure that we insure that building so that if something bad happens to it, your insurance company jumps in to replace that building. What about loss of income coverage? So if that building goes down, you had 16 tenants in that building. Now you're not making the money off of those tenants for an entire year. You know, that could be $70,000 to $100,000 that's going to be paid out in the claim as a part of that claim for your lost income. That's another tool that we put into the package of what we're offering. General liability coverage, I talked about a second ago, right? What if someone's injured? We're going to make sure that's there. If there's a board, we're going to talk about that directors and officers coverage, right? If you have agency lending, you're getting a Fannie or Freddie loan. Now they have all these expectations, some of them reasonable, some of them not reasonable. But we want to make sure that we have compliant policies, compliant coverage that aligns with what that lender is going to want, so you don't get surprised a week before closing with an extra $5,000 of insurance premium because your agent didn't put it together right and it's not compliant with the loan. So that is the way that we really say, okay, here is the tier of insurance that you need in this scenario. There are lots of tools in the insurance toolbox. Here are the ones we believe apply to your business and are the biggest risks that you have in this scenario.
So when you're insuring a property, what things specifically that you look for in order to insure a property? I mean, it's good for you as well as an insurance agent coming to the sponsor as well as for the deal sponsor, because you have a little bit more insight what they're getting into.
Yeah, absolutely. It's a great question. And I think my answer, as your listeners are listening, should also apply to how you make decisions about purchasing a property and knowing how much insurance is going to cost. So the number one thing that I'm going to ask first, obviously, is location. Insurance in South Florida is as expensive as anywhere in the country, oftentimes getting up towards $2,000 a door. Insurance in Texas is much more expensive than it was 2 years ago, but significantly less expensive than South Florida, for example. If you're getting insurance, I just worked on an insurance policy in Illinois, right next to me. I'm in Indiana, that we were at $250 a door. I just gave you numbers that are from $250 a door to $2,000 a door. That is a drastic difference, and that is really based on location. So I would say the first thing is that location. Now, that property in South Florida might be a killer deal. Lots of people are buying in Florida, and for good reason. But you've got to know in your pro forma that that's going to be the cost of insurance, making sure that that doesn't surprise you. If your guru said $250 a door and it's actually $2,000 a door, you're in big trouble, right? So those location is example number one. Year built is becoming a bigger and bigger deal. I think most value add investors know that 1970s builds you can oftentimes get at a lower purchase price, put some value add into that, and potentially raise the value of the property in a lot of different ways. Insurance companies look at 1970s builds and they have big question marks. They want to know, is there aluminum wiring, which was commonly used during the Vietnam War era instead of copper wiring? Are there breaker boxes that are known to cause fires? Is it a frame construction building, which is, as opposed to masonry or something like that, that's 5 stories high, right? So the insurance company wants to understand the structure and how risky it is. A structure with a friend of mine who's a contractor just pulled a bunch of knob and tube wiring out of a 100-year-old property over the course of the last couple of years. Over the course of the last couple of weeks, there's still knob and tube wiring out there. That's super dangerous, right? And insurance companies are obviously not going to be as interested in that. So first is location, second year built, and then I guess I got into the third really, which is the construction type of a property and what the updates are. If you have that 1970s build, but you did a full gut reno in 2018 down to the studs, all the electrical is new, all the plumbing is new, everything's new in 2018. With a lot of our insurance companies, we can just say it was built in 2018. And that obviously is going to change price a lot and really bring down your insurance premium. At the same time, if there's aluminum wiring and you just remediated it, that's not really going to get it done when it comes to insurance. It's still going to be a lot more expensive than if you had rewired it. Now, rewiring it is much more expensive. So those are the things that you have to balance. So the question was, what is the insurance company looking for in the building? And I would say location, age built, renovations, and then the last big one is sort of tenant base and crime score. So, all neighborhoods have crime scores based on history of crime and things of that nature. And, insurance companies are looking at those just like investors are and making a decision as to whether they, feel comfortable insuring a property in an area. I just had a property recently where someone asked me, "Hey, I'm thinking about having an armed guard. What does the insurance company think about that?" And it's a great question. I think, it seems like a safety measure, and it is a safety measure, right?
It is a safety measure.
Yeah. The insurance company was having none of it. If there's an armed guard there, they don't want to insure it anymore. And you say, well, wait a minute. Why? There's a safety measure. But you've got someone, you have someone sitting in a car with a gun that could potentially get into a fight. And then you've got lawsuits and all the things that come with that. So insurance companies, whether right or wrong, feel like an armed guard is actually a bigger risk than not having a guard at all. So there's interesting elements like that associated with crime.
Wow. Thank you so much for sharing that. And I like that. I know most of the time, the deal sponsors, they reach out to the insurance agents very early on when they get their hands on a deal. They wanted to look at it, what the insurance is going to look like or what the insurance company thinks, before getting the deal under contract or taking to the next level, because that makes perfect sense, because you wanted to understand too how much it's going to cost to get to insure something. So here I'm going to ask you this question about the underwriting. Because as a deal sponsor, we do underwriting. But when you underwrite a deal from the insurance perspective, what are some of the important things that you're looking for, or how do you underwrite basically?
So our underwriting process is fairly similar probably to yours. It's just different questions that we're really focusing on. We're focusing on the safety of the building, the safety of the tenant base, the safety of the relationship between the building owner and the tenant base. So where do we get that data? Well, it starts with many of the things I just talked about, right? The location, the year built, the structure of the building, elements like that are fairly easy to find and pull together. The next questions that are often around tenant base. So, do you require your tenants to carry renter's insurance is a common question that insurance companies ask. And it's really important that everyone listening that owns any kind of commercial real estate requires their tenant to carry insurance. There's a couple of reasons for this. One is because when something bad happens, I had a fire recently at a client's apartment. The tenant thinks if a tenant doesn't have renter's insurance, then they have no framing of who's going to pay to replace their stuff.
Yeah, in case.
And when there's a fire, and they're going to think that you, the property owner, are going to replace all their stuff. And most of us know that is not the case. Your insurance policy does not have coverage for the belongings of your tenants in any scenario, really.
Mhm.
And so you're disappointing a tenant in a really terrible situation, which is the first thing, right?
Mhm.
Obviously, the second is you just want the tenant to have coverage for their own belongings so that they have that feeling of having it taken care of, just like you do with your policy. But secondly, the most important thing for really you as a property owner in requiring renters insurance is that they have liability coverage. So I had a client recently, and I've probably had 6 to 10 of these claims, where a tenant has a candle on the bedside stand, falls asleep, knocks the candle over, hits a curtain or whatever. There's lots of different ways that candles and cigarettes cause fires. I can promise you this. I've seen so many of these claims. But there's a fire that happened there. The renter's policy can help to cover that loss instead of you having to file a claim on your own policy. So it creates a little bit of buffer, potentially your renter covering damage associated with something bad that happened instead of you having to cover that. So those are the reasons why folks need that kind of thing. So those are the types of underwriting things the insurance company is looking from. Many of those we can find on our own. We have data systems that help us to learn a lot of information. Others we have to ask, obviously, the investor for. And our intention at Shine is always to do that as quickly and smoothly as possible. What we don't want to be doing is peppering people with 5 questions, and then they answer 5 questions, and then I come back with 5 more questions. You know what I mean?
Right, I understand that. And for your company, if let's say if there's a claim, how long usually it takes to settle a claim?
That's a great question. It depends drastically. So I have, a claim that is really straightforward and clear could be settled in 2 weeks. Something that just is like, here's the damage, here's what we're going to fix, here's how much it's going to be, could be paid out really, really quickly. Sometimes in an injury scenario, when like I have a claim that was going on a couple months ago, where someone slipped and fell on some ice, and they broke their arm, right, and had to go to the hospital. It wasn't good, and the insurance company immediately paid out of what's called medical payments coverage, which is important coverage to have on your business policy. It's usually a small amount, like $5,000 or $10,000. I would suggest not having any lower than $10,000. And this coverage just pays out immediately. And so the insurance company could say, "Oh, it was going to be $6,000. It was $6,000 to get your arm fixed. I'm so sorry this happened to you. Here's $6,000." And what that does is avoid them hiring a personal injury attorney and getting into a big, nasty lawsuit. Doesn't always avoid that, but that's the attempt, right? Is to say, here, we can pay you right away. So some things happen incredibly quickly. Other things take a really long time. And oftentimes the reason that it takes a long time is the remediation company. So the contractors involved, them getting their estimates together, and then the insurance company confirming that estimate aligns with the expected scope of work, and then the remediation work happening, and then the contractor who's going to come in and fix all the damage, giving their scope of work, and the insurance company looking and making sure that fits. So you see all this back and forth that's happening. That can take a little while. And so part of what I do, in fact, I was doing this right before this interview, was jump into these situations and get them moving more quickly. If an insurance company adjuster is not communicating very well, then I'm going to jump in and say, "Hey, I need you to communicate better." If an insurance company adjuster isn't doing what I feel they need to do, I'm going to jump in and say, "Hey, this needs to be done better," or we're going to go to a supervisor or the supervisor's supervisor or wherever we need to go. I have leverage inside of these companies. I don't work for any of these insurance companies, but obviously I have relationships with them, and they want to keep their relationship healthy with me, and I want to keep it healthy with them. And so that gives me an advantage when working with companies to really get things done.
So overall, what would you recommend for us, the deal sponsors, to manage the overall risk?
So I think the number one piece of advice I have is to pick a good insurance advisor who you trust and who can explain things clearly and easily. So it's the same as an attorney on your team, the same as a financial advisor on your team, the same as your property manager. When you're building a commercial real estate business, you want all of your team members to be A+ players. And that's true on the insurance side as well, right? You're not supposed to know everything about insurance, right? You're not supposed to know everything about law. Exactly. And so that would be my number one piece of advice is pick the right advisor, someone who explains things clearly. As far as what coverages you want to have, just a very high level, quick overview. You want to have a solid replacement cost for the buildings. How much would it actually cost to replace buildings? Ask a contractor or whatever. Usually it's around $125 a square foot for a B-class property in most parts of the country. Obviously, if it's an A-class property, it's going to be much higher. Oftentimes, especially in the current environment of cost of building and cost of contracting, it might be higher than 125, but know what that replacement cost is and make sure your insurance company covers it. Make sure you have enough loss of income coverage. I already talked about that, Vinky. And so, you want to make sure that you have enough coverage if that building is down for an entire year, that pays out. And then general liability coverage would be the third thing I would say, just back to that idea that if someone else is injured, that's something you can't control. If a building goes down, you know how much it would cost to rebuild it, right? If someone sues you for a back porch collapsing during a party, there's just no idea how high that could go, right? And so you don't want to mess around with you want to have enough coverage on the general liability side. And so those are three coverages that I think are top level, most important to have. But I think that bottom line is have an advisor who is clear, who knows commercial real estate, and who, has access to the best companies. And if you have that, that's 90% of the battle right there.
All right. So I'm going to ask you one question. What should I ask you that I did not have enough knowledge to ask you?
I think the thing that there's so many things I think of, Vinky, I got to nail it down to one and answer it quickly. I think the one question that I think is important is, should I hire a public adjuster? A public adjuster is very similar to a personal injury attorney. When you're in an accident, a personal injury attorney comes and says, look, I'll deal with the insurance companies. All I ask is that you give me 30% of the money I get from the insurance companies. So there's public adjusters out there doing that. And I think there are a lot of bad public adjusters, and a lot of insurance claims go south really, really quickly because of public adjusters. Having said that, there's also good public adjusters out there, just like there's good personal injury attorneys. I just think for all of your listeners, don't jump on a public adjuster too quickly. If you are having a problem with an insurance claim, go to your independent agent first. And if your agent can't help you solve that problem, maybe it is time to bring someone in to help you.
Right. So can you share one golden nugget with my audience? Risk management related or insurance related?
I just think that when you look at the best business people out there, the golden nugget does have to do with risk management and opportunity. When you see people doing big deals, $100 million property deals, it looks like they're taking a really big risk. And in some ways they are. But because they've built a system, a structure, they understand the 4 quadrants of risk, they understand everything underneath it. To them, it is not as big of a risk because all of the risks have been managed, and that is how big decisions get made. So no matter where you're at in your journey, my golden nugget is start to think about the balance of risk and opportunity in a really, really clear way so that you can build that foundation so that big decisions can get made quicker and with more success.
Great. So this brings us to our rapid fire round. I'm going to ask you 5 questions, and you're going to answer in one word or one sentence only.
I love it. Yeah.
All right. So what is one most important thing you have learned in your life, and how did it change your life after learning it?
Serving others elevates yourself. I believe in that we rise by lifting others.
I believe in that 200%. What is the best book that you have read and recommend to my audience?
I think it is. I will just give you an author, Jay Baer, and it's all about marketing. But his book, Utility, his book, Talk Triggers, his book, Hug Your Haters, they're all incredible.
In one word, what does life mean to you?
Oh, in one word.
Mhm.
Um, it's kind of cheesy, but the word that comes to my head is just like love, right?
Yeah.
Or happiness. I think happiness. Those two maybe are very similar to each other.
Yeah, I mean, you're right. See, in this life, everybody needs only three things: love, happiness, and peace.
Yeah, peace
And
is
we
good too.
forget that all our life we're just running after something else. But
Yeah.
these are the basic needs that every human being have, you know.
Mhm.
So once you realize that, that's a
Yeah.
big realization.
And love is passion, right? And I think having passion it provides so much meaning for you as a human, and so that's important too.
That's true. So this brings my next question. What is your biggest passion?
My biggest passion, I mean, obviously, my love for my family is number one. I love to teach. My passion, just as a human, is to boil down information and share it with others. And I just try and do that. Like I've noticed that every direction I've gone in life, obviously being an educator is a clear one, but all I know how to do is teach. And so far that's worked out pretty well.
That's good. Last question. If you can turn back in time and talk to your younger self, what would you tell yourself and why?
I remember being 21 and being so excited to be 25 because I figured I'd have it all figured out. And now I'm 46 and I'm still in the same boat. You know, I think that I would tell myself to um, just believe in yourself. I've always
Mhm.
had kind of a servant mentality, and sometimes that the negative of that is a lack of belief that I could do things well. The other thing I would tell myself is invest in real estate earlier.
That's everybody's answer.
But yeah, I mean, I money is something that I've really not had very much of for the majority of my life. I'm a pastor's kid. I grew up a pastor's kid. And so the idea of service over money has been a mentality my entire life. And so now that I'm in a little bit better of a financial position and making decisions that are more well-rounded financially, I think there's a lot of figuring that out. But yeah, financial knowledge probably would have been something I would have told myself.
I'm going to tell you a little secret over here. It's an Indian saying: when you're serving others, when you're in service, money follows you.
Huh.
So
Yeah.
believe in that now. So how can people reach out to you?
Shineinsurance.com. I'm also on LinkedIn a lot. I'm on all the socials really. But if folks want a one way to just get a really quick number for their underwriting on multifamily properties, you can go to shineinsurance.com/ballpark. You just put your address in there, answer 9 yes or no questions, and you'll immediately get a ballpark number for penciling deals. So if you want to make sure that you're at least in the ballpark, when you're doing that front end penciling, that's a great way to do it.
Great. It was so nice to chat with you today, Jeremy.
You as well, Vinky. I really appreciate you. I love your show and what you're doing. And thank you so much for giving me an opportunity to share a little of my knowledge with your audience.